Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 30th session. Last day I have discussed covered call, covered put, protective call, protective put and just started future pricing. Today it will be continued. Now come future pricing. The fair value of a future price with continuous or daily compounding can be expressed as F is equal to S into e to the power RT. F is equal to F is future price, S is spot price and E is a constant 2.713 to the power R is rate of interest and T is the time. Now, for example, if the cost of 10 grams of gold in spot market is rupees 60,000 and the cost of financing is 12% per annum continuously compounded, the fair value of a 4-month future contract will be S 60,000 into F to the power R 0.12 T 4 month, that is 4 by 12 year, that is equal to 60,000 into e to the power 0.04, that is equal to 62,448.60. Now let us extend the concept of cash and carry model by adding the inflows during the holding period of underlying asset. For instance, underlying asset like securities, that is equity or bonds, may have certain inflows like dividend on equity and interest on debt instruments during the holding period. These inflows are adjusted in the future fair price. The modified formula will be F is equal to S into 1 plus R minus Q to the power T. It is annually compounded. R is the rate of interest, that is outflow, minus Q is the inflow, that is dividend or interest on debenture, that is R minus Q is the net outflow to the power T is the time, where F is the fair price of future contract, S is the spot price, R is the cost of carry and Q is the expected return during the holding period T in years. When we use continuous compounding, the formula will be F is equal to S into e to the power R minus Q to the power T into T, R minus Q into T. Cost of carry is the relationship between future price and spot price. It measures the storage cost in commodity market plus interest that is paid to finance or carry asset till delivery, less income earned on the asset during the holding period. For security derivatives, carrying cost is the interest paid to finance the purchase less dividend earned for equity and interest earned for bond. For example, a trader buys an index in cash market at 10,000 level, that is purchase of all the stocks constituting the index in the same proportion as they are in the index. Cost of financing is 12% and the return on index is 4% per annum, spread uniformly across the year. The fair value of index after 3 months will be F is equal to spot price into 1 plus cost of holding minus holding period return to the power time to expiration divided by 365. That is converted to year. That is equal to 10,000 into 1 plus 12% 0.12 minus 4%, that is inflow, to the power 90 divided by 365 is equal to rupees 10,191.58. Alternatively, it is continuous compounding. F is equal to 10,000 into e to the power r minus q to the power 90 by 365 is equal to rupees 10,199.22. Now come convenience yield. Financial derivatives on bond and equities are used for investment and hedging purposes. Holding the underlying bond or stock does not add any additional value compared to holding a future contract on the same bond or stock. But in commodity, the trader enjoys some benefits from the ownership of essential commodities like grains, vegetables, and energy products, heating oil, rather than buying a future contract on that commodity which generate convenience yield. Sometimes due to supply bottleneck in the market, the holding of underlying commodity may become more profitable than owning the future contract due to its relative scarcity versus huge demand. Producers may face losses if they do not have enough inventory at all times for uninterrupted production. An oil refiner may enjoy a convenience yield on crude oil inventories, and without it, production will be interrupted and the refiner cannot produce any finished product. This also includes a situation where a manufacturer is more comfortable to buy in spot with a particular supply only due to other service related reasons which may increase the convenience yield. Due to convenience yield, difference between future and spot reduces as the manufacturer are open to have position by outright purchase directly from spot markets due to ease of position, which helps in running their production cycle smoothly. Considering the above mentioned factors, the future price can be updated as F is equal to S plus C minus Y, where F is future price, S is spot price, C is cost of carry, and Y is convenience yield. Now there are two models I have already discussed, cash and carry model, and next is expectancy model to find out the future price. Now come second model, expectancy model. According to expectancy model, the future price of an asset is basically what the spot price of the asset is expected to be in the future. That is, future price is nothing but the expected spot price of an asset in the future. That is why market participants would enter future contract based upon their estimate of future spot prices of the underlying asset. This means If the overall market sentiment is bullish for an asset in the future price of the asset will be positive. If in the same way the market sentiment is bearish, what that would lead to a fall in the future price of the asset. Unlike cost and carry model, this model believes that there is no relationship between present spot price of the asset and its future price. This will be not cost, this will be cash and carry model. According to this model, future can trade at a premium or discount to the spot price of the underlying asset. Future price give market participants an indication of the expected direction of movement of the spot price in future. Next comes basis. Basis, the difference between spot price and future price is called basis, which is observed in the practical level. If the future price is higher than the spot price, basis for the asset is negative. That means market is expected to rise in future. If the future price is less than the spot price, basis for the asset is positive. That means market is expected to fall in future, indicating a bear run on the market in future. Importantly, basis for 1 month contract would be different from the basis for 2 or 3 months contract. Therefore, the definition of basis will remain incomplete until we define the basis for 1 month contract, 2 month contract, etc. Next comes convergence. It may be stated that future prices are essentially expected spot price of the underlying asset at the maturity of future contract. That is, ultimately both future and spot price converge at the maturity of the future contract. Accordingly, both futures and spot price converge at the maturity of the future contract, as at that point of time there cannot be any difference between these two prices. It follows that the cost of carry, which determines the differential between spot and future price, diminishes with each passing day, and the differential must narrow, and on expiry date or delivery date, in the case of commodity, the cost of carry reduces to zero and the spot and future price converge. This is known as convergence. When future price is higher than the spot price of an underlying asset, market participants may expect the spot price to go up in near future. This expectedly rising market is called Contango market. And the future market are trading at a premium in this Contango market. When the future is lower than the spot price of an asset, market participants may expect the spot price to come down in future. This expectedly falling market is called backwardation market. It is the opposite to Contango, much less common because backwardation tends to to affect market with seasonal changes in supply and demand. The natural gas future market is often in backwardation as it sees increasing demand in the winter months and shortage in supply. Traders would take a position in backwardation market if they expect the price of natural gas to fall, which could happen if supply increases and demand remains at the previous level. This backwardation arises in agricultural product due to seasonal changes in supply and demand. During the sowing season, spot supplies are less while it increases during harvesting, which will come after around 3 months. Hence, the spot prices are expected to be lower during harvesting months, that is 3 months later, than the present spot price, that is while sowing. Hence, future will be priced lower than the current spot price as it is expected to have more supplies of stocks after 3 months. The traders use Contango and backwardation to assess current future price in relation to the expected spot price of a commodity at delivery. This information can help a trader to decide whether to go long or short, depending on whether they believe that the future price will rise above, fall below, or meet the spot price at the delivery date approaches. As the delivery date approaches, if a situation arises where future price will not converge on the spot price as the future price approaches its delivery date, that is, future price remain either above or below the expected spot price at delivery, then an arbitrage opportunity may arise in the underlying market. Now come one problem. Mr. X is planning to invest rupees 20 lakhs in bank deposit for 1 year. All the bank offer interest rate of 12% per annum for 12-month deposit. Mr. X gets terms from 4 banks for deposit, which is given below. Bank P, interest will be credited at half yearly basis. Bank Q, interest will be credited at quarterly rate. Bank R, interest will be credited at monthly rate. Bank S, interest will be credited at weekly rate. Which bank will be preferred by Mr. X? For Bank P, interest will be credited at half yearly basis, hence A is equal to P into 1 plus R by M to the power M into N, where A is the amount received at the end of 1 year, P is the amount invested, R is the rate of interest per annum, here 12%. M is the number of compounding in a year, here M will be 2 for semi-annual compounding in Bank P, and n is the number of years. Here it is 1 year. Now for bank P, A will be 20 lakh into 1 plus 0.12 divided by M, that is 2 to the power 2 M into N. N here it is 1, so 2 into 1. If it is 2 here, then 2 into 2 to the power 2 into 2. If it is 3 here, then to the power 2 into 3. Now 20 lakhs into 1.06 to the power 2 is equal to rupees 22 lakhs 47,200. For bank Q, interest will be credited at quarterly rate. That is, here M is equal to 4. A is equal to 20 lakh into 1 plus 0.12 divided by M, here it is 4 to the power 4. If it is 2 here, then to the power 4 into 2 is equal to 20 lakh into 1.03 to the power 4 is equal to rupees 22 lakhs 51,000. For bank R, interest will be credited at monthly rate. That is, M is equal to 12. 20 lakhs into 1 plus 0.12 divided by 12 to the power 12 is equal to 20 lakh into 1.01 to the power 12 is equal to rupees 22 lakhs 53,600. Now come, interest will be credited at weekly rate, that is 52 weeks. Now 20 lakhs into 1 plus 0.12 divided by 52 to the power 52, and you solve it and you come, the result will be 22 lakhs 54,600. Next problem. Given spot price of share of XYZ is rupees 2,500. Risk-free interest rate is 9% per annum and 12% per annum. Compute the theoretical forward rate of the share after 1 month, taking the rate of interest is 9%, and after 3 months and 6 months, taking R is equal to 12%. The theoretical price of security is equal to S into E to the power RT. Here S is equal to spot price, R is the rate of interest, and T is the period in years. Theoretical price after 1 year, taken R is equal to 9% and T is equal to 1 by 12 year, that is 0.0833 year. So 2,500 into e to the power 0.09 multiplied with 0.083 R into T is equal to 2,500 into e to the power 0.0075 is equal to rupees 2,518.75. Next, theoretical price of security after 3 months, taken R is equal to 12% and T is 3 months, that is converted to year, 0.25 year. That is equal to 2,500 into e to the power 0.12 into 0.25, that comes to rupees 2,577.50. Lastly, theoretical price of security after 6 months, where R is equal to 12% and T is equal to 0.5 year. So 2,500 into e to the power 0.12 into 0.5, that comes to rupees 2,655. Now, strategy in overvalued and undervalued in cash market and future market. Here I have shown the overvalued in cash market and in future market. In cash market, the stocks that have a higher market value compared to its intrinsic value or worth are considered overvalued of stocks. That is, market value is higher than the intrinsic value of the share. It is important to note that an overvalued stock is likely to experience a price decline in the near future. In cash market, you remember it. So, these stocks are ideal for investor looking to short a position. This entails sell share now to capitalize on an anticipated price declines. Investor may also legitimately trade overvalued stock at a premium due to brand superior management or other factors, that is corporate, that increase the value of one company's earnings over another. In undervalued stock, that is when the stock have a lower market value compared to intrinsic value, the strategy of the investor will be to buy share now and sell it when share becomes overvalued to capitalize on anticipated price rise. So the market observes two levels. One is high, another is low. Now you see, this is the pattern of the market. It is high this and low this. This is called resistance level and this is called support level. Now resistance level where the price normally stops rising and dips back, at which one can expect more sellers than buyers. So when market reaches this level, so one can expect that more sellers at this point than buyers. And when it comes down and reaches this level, it is called support level. There is support level where price regularly stops falling and bounce back, so it is go up, and at which one can expect more buyers than sellers. This is the pattern of market moving. Example, stock price is rupees 40 and ROE means return on equity. ROE is 8%, EPS is rupees 3, is the stock is overvalued. Given actual stock price is rupees 40. That is market price now at present. Return on equity is 8%. EPS is rupees, earning per share is rupees 3. Then price earning multiple is equal to 1 by ROE, that is equal to 1 by 8% is equal to 12.50. Market price per share is equal to PE, price earning ratio, into EPS, earning per share, is equal to 12.50 into 3, that is equal to 37.50, which is less than the actual price 40 rupees 40. So it is overvalued. The strategy will be to sell shares now and buy the shares when the price of the shares decline. Now I stop the class here. Next day I will continue this future pricing. Thank you.